Welcome to another session of personal finance training. Today we're going to be looking at the rich dad poor dad concept in terms of looking at the fundamental principles with the traditional personal finance, as well as my book, which is the best kept secret in personal finance. Like, share, subscribe. Okay, so yes, we said that we're going to be looking at the rich dad, poor dad, and we're going to also be looking at the traditional methods of personal finance, also incorporating my book, which is the best kept secret or secrets in personal finance. So we're going to have four arguments. Argument number 1, 2, 3, 4. You're going to see exactly what they are. And then we'll conclude. So the first argument, argument number 1, a house is not an asset if you live in it and you pay a mortgage. So for the poor, most time as a poor person, if you own the house, you have a smaller deposit. According to Rich Dad Poor Dad, that's a liability because you're servicing the mortgage. But under the other method, which is if it's an investment property, it's an asset. So if other people, tenants are servicing the debt, it's an asset. But if you, being the owner of the property, is servicing the debt, it's a liability. I don't necessarily agree because I would say, and I have my reasons why. Let's look at an example. Let's say you buy a property for 200,000. So in the very beginning it's 200,000, the debt on the property is 180,000 under the poor concept, which means that you have a 10% deposit in the property. After 4 years, the property is 220,000. It's an increase in value by 20,000, and the debt would, let's say, reduces by about 10,000, so it's 170,000. But under the rich dad concept of it being an investment property, it's 200,000, and after 4 years, it's worth 215,000. The reason for the 215,000 is the fact that if it's an investment property, tends to damage the property, so the wear and tear on the property is much higher than if you were to be the main person living in the property. The debt would be 150,000 and then goes to 140,000. 150,000 due to the fact that you need to have a substantially higher deposit with an investment property than it's being your main residence, and so that's the reason for that. But let's look at the net. So the net under the poor concept would be 50,000 using this example, and the net under the rich concept is 75,000. But in both instances, we can still demonstrate the idea that they're assets, because in both instances, we can see that the property has actually appreciated over a period, and the deposit has actually also increased over the period. The deposit for the rich was 50,000, so it is now increased to 25,000. And the deposit under the poor was 20,000, and that has increased by 30,000. So it's a win in a way for both. So I would say that they are both assets. Now, my argument number 2, in terms of the style of the balance sheet. So under Rich Dad Poor Dad, they have 2 categories of the balance sheet. Category number 1 would be asset, and the next category is liabilities. But under the traditional method of looking at it is asset, liabilities, and capital. All right, so there are 3 categories, and this is also demonstrated in several books, all over the world, and by experts as well. So I would not, and my book, The Best Kept Secret in Personal Finance, also demonstrate the idea. So it's asset, liabilities, and capital. That's the core concept. All right. So I don't necessarily agree with the idea of it being 2 categories only. Now, we can also demonstrate this via an example. Let's say you buy a house for 200,000, as we mentioned earlier, and therefore under the Rich Dad Poor Dad principle, the asset is 200,000 and liability is 180,000. But where is the rest of it? We are not sure. But let's look at the best kept secret in personal finance. It's 200,000 in asset, liability is 180,000, but we have capital, which is 20,000. So we're actually demonstrating the idea of the other side, which is the capital, which is missing from the Rich Dad Poor Dad concept. Now, another idea we can look at is the statement for the rich. Now, according to the Rich Dad Poor Dad, the statement, you have several incomes, expense, and several assets, and liability, small liability. But I would kind of differ on the idea. I would say, in terms of the rich, their main the job for their main income tends to be quite high. Then you have fees from royalties. Then you have income from rent income from investment property. Then you also have investment incomes, etc. But the balance sheet has something that the poor as well as the middle class do not have, which is goodwill or investment in shares and royalties. So that is a huge proportion of the wealth of the rich. And this is not necessarily the case in terms of the poor and the middle class, because they do not have the ability to do so, to accumulate that wealth. And then you have their core assets, and then you have investments in cash. So, but on the liability side, I would say they have huge mortgages in most instances, high-end assets like yachts and planes and even boats in some instances, and other fancy stuff, and expensive jewelry and cars, and then you also have bonds. So I think their debt is quite high as well. It's maybe not, it could be proportionally similar to the poor or even the middle class. So we have to take that into account. I do not think the rich entirely keeps all their money. They may have a higher amount, but proportionally not necessarily the case. The other argument is that the poor have a statement that looks like this, and you can have a look. Income, expense, and then assets, and then they have huge amounts of liabilities. I don't necessarily agree. I think their statement is more like they have their main income, then they have rent and living related expenses, which is reasonably high. They may have a car or not, but they have equipments, etc. And then they have car payments and also debt on credit card, etc. But I do not think you have a situation where their debt is 3 times their assets. So I think there's more of a 1-to-1, so 1 in asset and 1 in liability, or a 1 to 1.2, 1.3, or even 1.5. But I don't think there's a situation where you have 1 in asset and 3 in liabilities, which is kind of almost what is demonstrated by the Rich Dad Poor Dad concept. I do not think the poor would be able to qualify. They don't have the credit, because in order for you to get debt, you would need credit. And most times to get credit, you would need an asset. And the poor most times do not have the ability to acquire certain assets to even get debt in the first instance. And their income would not necessarily substantiate them being able to do so. So it's, so that idea I don't necessarily agree with. I think, it's kind of deviating from the realities of the scenario. Okay, so what can we conclude about the Rich Dad Poor Dad concept or book? My conclusion is it's a very good book, and it actually deviates from the traditional method of personal finance, but it is not, I would say, it is not necessarily to be held or read independent of other books. I think you would need to have a balance of other personal finance books to kind of increase your knowledge and make you a bit rounder. I think my book, which is The Best Kept Secret, or Best Kept Secrets in Personal Finance, is also another book that you might want to read in addition to reading the Rich Dad Poor Dad book. Again, my intent is not to put down the book, and that is important. It is a very good book, and I think Mr. Kawasaki has done an excellent job in actually educating the world on thinking differently about personal finance. So he has done a very good job. I recommend the book. It is an excellent book. But I also can see deviance on some traditional concepts, and that is why I've actually done this video, so that we can see a difference in the arguments. And talk about it. And the idea is for us to build together and learn together, and have a better appreciation of the academics behind the principles of personal finance. So I'd like to hear what you think. So write in the comments below. And also, if you so desire, Mr. Kawasaki, I'd like to hear what you think as well. And other experts. The main idea is to open a floor so that we can all argue on this idea of the principles and the arguments I put forward. Argument number 1, argument number 2, argument number 3, and argument number 4. You have a look at the video and you'll see the various arguments. But next time we will talk about something and build even further. But like, share, subscribe. Thank you.